The final speaker is Daniel Burnside. Dan is Vice President and Director of Quantitative Research at Federated Clover Investment Advisors in Rochester. So we have somebody who is experienced from the trenches here, having had extensive experience working with both individual and institutional clients on a variety of investment and risk management issues. Dan also teaches courses for us up at Simon that are one very popular and well subscribed, and two very useful and important. He's a chartered financial analyst and a certified financial planner. He holds a PhD in engineering and mathematics from Cornell University, and we're proud to say he has an MBA from the Simon School. So, Dan?
Okay, so I heard that this was a forum on financial regulation, and so I guess implicitly what that's really about is reform. That's a word people like to use. That's a euphemism for changing something, and some people like that, and some people don't. You know, here's my overall take on the whole issue of financial reform right now is that, you know, the horse has left the barn, okay? You know, the damage is done, and it was a lot of damage. And we have to make sure that we don't have something like that again, but I don't think something like that's going to happen for a while. I don't know when it's going to happen, but I'm thinking it's a 10 or 20-year kind of thing. It's not going to happen before the November midterm congressional elections, okay? We've already unwound a lot of the precipitating factors of this. I think this is going way too fast. You know, reform proposals, whether people say it or not, are hypotheses of causes of some kind of problem, right? But they often are not stated that way. But somewhere in the proposal is someone's idea about how something happened and how it could be prevented. And it's hard work to figure those things out. I don't know all the answers about the things we're going to talk about tonight, but I do know that scholars are going to be studying the events of the past couple of years for decades. It's going to be a serious topic of academic study, just as the Great Depression is still to this day a topic of serious study. And yet, you know, as I said, we've got these elections coming up, and I'm afraid that these politicians want to get out there in time to tell everybody that they did something about this, you know. Now, President Seligman, he referred to a 2,000-page House bill, and I was looking at the Senate finance bill, or one version of it, and the Senate, I guess, is a little more efficient, maybe because they have fewer members. It's only 1,100 pages long, but it's double-spaced, so I guess, well, you know, it's not as long as it sounds. I mean, I wanted to read that before I came to talk to you tonight, but I think it's impossible. So let me give you a sense of why I think the cart is being put in front of the horse here. While we've got the senators breathlessly, you know, twittering to us about, you know, their moment-by-moment negotiations, in parallel, we have this other group of people that the President of the United States has appointed called the Financial Crisis Inquiry Commission. And so as not to mischaracterize them, I'm going to quote from their mandate. It says, their purpose is to, quote, examine the causes, domestic and global, of the current financial and economic crisis in the United States. I mean, that sounds like a pretty important thing, especially if we're going to, you know, prevent such a thing from happening again. There are 10 members of this commission. They were appointed in July of '09, and they're going to produce a report. And the deadline for the report is December 15th, 2010. I mean, we're going to solve this problem before anybody even tries to take a stab at explaining it, you know, what happened. Just as a little jab, I'll throw in that I looked at the bios of all these folks, and I couldn't find any economists. The chairman is a history major. I like history. That's a great subject of study. I just don't know why we don't have any economists on that board. I mean, it says right there in their mandate, economic crisis. I mean, seems like an economist should be involved, but apparently not. So the senators and the representatives are going to solve this problem, and then a few months later, these other people who are not economists are going to explain to us what happened. And I'm reading these preliminary, unpublished academic papers where people are just trying to scratch out some understanding of some of these things that have happened. It's going to take a long time to get through. That's why everything I'm saying is so tentative. Okay, so, all right, I've challenged myself here to give you a cause for these problems, and I will. You know, I'll just state it as an unproven proposition that, you know, any mess that's sufficiently gigantic in size could not possibly have one cause. I mean, there's got to be a million things going wrong that just kind of all happen together. And, you know, this thing has a lot of that, okay? Perfect storm, that's a nice cliche I keep reading, you know. There are a lot of aggravating factors to this, and I'm going to just briefly mention them just so you know that I'm paying attention. But in my assessment, my opinion, the main cause of this problem that we had is that we have a gigantic banking system in the United States that's evolved over a few decades now that some people call the shadow banking system. And we had a run on that, okay? I think that's what happened. And I'll give you some more details in a few cards. So let me talk about some of these aggravating issues because some of them are interesting. You know, they say you can't tell who's swimming naked until the tide comes in. And, you know, the tide came in, and there were a lot of people out there naked. And, you know, they were naked before, but nobody noticed. Some of these issues have been mentioned by some of the prior speakers tonight. You know, the whole way we originated these subprime mortgages, these mortgages that were given to people who, by traditional historical standards, you know, wouldn't have been able to get a mortgage. The whole way that was done, there are a lot of problems with that. Okay, not just economic problems, but you know, there are people that are going to have criminal problems in there. There was a lot of mischaracterization, you know, bait and switch, you name it. There was a lot of bad behavior. Did that cause the financial crisis? I don't think so, but it didn't help, you know. The securitization of mortgages, I mean, here's a financial innovation that really kind of changed everything. I mean, it used to be that when the bank or the savings and loan, the credit union gave somebody a mortgage, that was an asset of theirs, and they kept that on their balance sheet. And, well, because they did that, they were pretty diligent about making sure that that person had a job, and they made sure that they put down enough money on the house so that if the house value went down, they wouldn't have an incentive to walk away from it. They'd continue paying their mortgage, you know. That's the way it used to work. But a lot of mortgages now, and most of the subprime mortgages during the period we're talking about, they were bundled up into these big buckets, and then they were sliced into pieces, and then they were kind of sold everywhere, right? There's nothing nefarious about that in itself. Everybody got to be diversified, you know, that's supposed to be a good thing. The problem is that the companies that originated the mortgages didn't, as we say, they didn't have any skin in the game, and once they got the signature on the application and they threw the loan over to somebody else, they got a fee and they were done. And that's why we were giving mortgages to people who, didn't have a job, didn't have any income, didn't put down any money. I think we had a liquidity glut after the last recession. If I read the Federal Reserve Chairman correctly, I think that he thinks that too, although I haven't heard him say that explicitly. We've talked about the credit rating agencies. That thing's a mess. There's so many conflicts of interest in there, I don't know how anybody expected that to work correctly. The SEC, okay, well, I have people here tonight who know more about that than I do, so I'll just say 2 words about that. Bernie Madoff, okay? If you can't stop that, I mean, what are you doing? I think that's the opinion of the guy on the street, and I'm one of those guys. Fannie Mae and Freddie Mac, these government-sponsored entities, I don't know why they exist. They seem to be a strange way for the government to implement some kind of housing policy without having the congressman, discuss it and put it in the budget. And then somehow we allow those organizations that are backed by the U.S. government to turn around and give campaign donations to senators and congressmen, many of whom are sitting on the Senate Finance Committee who are debating this bill right at this moment. I just don't understand that. We had mathematical models of mortgages that weren't right. We should have a clearinghouse, a central place where derivatives, certain derivatives, get traded, just like we do for futures and agricultural products. Okay, and we had problems because we didn't do that. We had an explosion of so-called off-balance sheet activities, which are not inherently bad, but I think they distorted the accounting and they made it look like companies weren't doing things that they were, and they were more levered than we thought they were, and it got them around certain regulations. Okay, Cliff was talking about how you have a regulation and then people start to behave differently because of it. Well, there's a good example of that. I'll even blame the internet. I mean, the Washington Mutual run was mostly on the internet. I mean, people didn't run down to the bank to get the money. They heard the news, they went online and they took their money out. I mean, it didn't take very long to get the money out. Did the internet cause the problem? I don't think so. But okay, so I was talking about banks, shadow banks. Okay, what's a bank? All right. Okay, this is my definition of a bank. A bank is an entity that lends long and borrows short. Right? They invest in things where they lay out the money for a long time. It's hard to value those things. It's hard to sell them. It's illiquid. But they finance it with short money. People give them the money and maybe they might want it back soon. Okay? That's a very important function in society because most of us want to do the opposite. Right? Most of us want to own a house, borrow the money for a long time, and then we have a little money, we put it in the bank, but we might want to go get it at any time. Well, somebody's got to be on the other side of that, and I call those banks. Now, there's an old expression that banks are special, and they are. Not just because they provide this valuable service, but there's a special risk that they have, which is that they're at risk of having runs. And I won't go into a colorful explanation of that because I assume that you all watched It's a Wonderful Life with Jimmy Stewart, where he explained that Bailey Savings and Loan, how it worked. Right? He explained to everybody that there wasn't any money there. The money was in their houses and businesses and so on. And yeah, that's right. So, this is a great system of providing liquidity, but everybody can't use it at the same time. That's the key. Some of us, some of the time, can go and get some of our money and everything's fine. But we all can't go at the same time to get our money because it's not there. And, to make it even worse, if we think that the other people are going to get their money, then we want to get there first. Okay, that's why it's called a run. Because, you run there, all right? Now, how do we handle this problem with banks? Well, we used to have runs in the 19th century, and we had runs for the first few decades of the 20th century. And then we had some new legislation, and we created the FDIC in 1933. And we said, okay, we're going to prevent the runs by giving people confidence that the money will be there if they go to get it. And then they won't have to go get it today because they're worried they won't be there tomorrow, because they know it's going to be there tomorrow. And then they won't go get it today, right? And that's worked for 80 years. But there's an economic principle that's very important that goes along with that we call moral hazard. And that is, when you insure somebody, it changes their behavior. And when you tell a bank or anybody that you're going to back them up if something bad happens, they're not as prudent. And from your perspective, they might behave recklessly, but not from their perspective, because it becomes a heads they win, tails you lose kind of thing. So, we have a huge economy of institutions that do what I just described, but they're not banks. Lehman Brothers, Bear Stearns, Goldman Sachs, Merrill Lynch, Morgan Stanley, those are just the big ones. GE Capital, all these little loan originators, some hedge funds. eBay, eBay does some of the stuff I was talking about. Just to give you just one number about how big this stuff is, those five that I mentioned at first, at their peak, their liabilities, hard money that they owed was about $9 trillion. That's about half of our GNP for a year, so that's a lot concentrated in those companies. So what happened? Well, we had an economic slowdown. The business cycle has not been repealed, as they say. It happens. But then we had a run on these, collectively on these organizations. And why did it cause such a serious problem? It caused a serious problem because we did half of the thing that we did with the banks, which was the part about backing them up. We provided insurance for them. We bailed them out. We gave them a huge amount of money. It's going to take a long time even to figure out exactly how much money it was, but it was a lot. But we didn't get anything, we didn't do the other part of it. We didn't monitor what they do to make sure they didn't do anything reckless. And in fact, they did a lot of things that look reckless. But it was very rational from their point of view, because if it worked out, they were going to make a ton of money. And they made a ton of money for a long time. Why did we bail them out? Because they were too big to fail. It would have caused too much damage. I'm increasingly seeing economists use other phrases for that. I'm hearing people say, too systematic to fail, too connected, as President Seligman said, too connected systemically to the economy, too interconnected to fail. My favorite expression that I've read is, too connected to Goldman Sachs to fail. And I don't think the person who said that was joking around. Now, what are we going to do about this? The system's still there. Some people have proposed that the way to deal with this moral hazard problem is, we're not going to bail them out. That's a cutesy thing that academics say that don't have to make any policy decisions, but, that's not going to happen. We've been watching governments bail out organizations for centuries, and they're going to keep doing it. We have to prevent it from happening, okay? These organizations are getting all the advantages of being banks without the cost. Okay, so I don't have the magic, recipe for this, but I have two proposals or two ideas that I think should be part of what's going on. Besides, that everybody should just slow down and take a breath and not try to pass something by November. The first is that I agree with President Seligman that we need to extend regulation in some way, shape, or form to these things which are not banks, because they walk like banks and talk like banks, and we back them up like banks. Okay, I don't know how to do that. Okay, should the Federal Reserve do that? I don't know. The Treasury Department? I don't know. Should it be some independent new something or other? I don't know. It shouldn't be some group that's begging Congress for money. every couple of years. That's not going to work, because as soon as they do something that one of the parties doesn't like, they'll make sure they don't get any money. Okay, so it won't work. We have to have some way to, like some built-in kind of governor on this thing. People have been talking about how to wind down these organizations when they screw up, and part of the Senate bill is, these companies have to write their own funeral plan. I think that's too far after a problem. I think it has to be much, much sooner. I like the idea that we set up a capital structure for these companies that has an automatic aspect to it. I particularly like this idea that some of the debt of these companies could be automatically turned into equity if a certain triggering event occurs. Okay, not only will that give them equity that we as the taxpayers don't have to give them, but it'll also mean all their counterparties now think it's safe to do business with them. And the creditors, the people who loan them the money, they don't want that to happen. They don't want their debt to go away, so they're going to now monitor. Everybody's gotten a free ride. I like that. I don't know if that's going to work. There is an aspect of that in the Senate bill, but I don't know how laws get made, so I don't know what's going to happen. So that's all I got.